Imagine a company, right? It powers millions of homes, millions of businesses, Midwest, Mid-Atlantic, huge area. Now think about what it takes for a giant like that to, well, not just stay afloat, but actually boost its finances significantly, all while making these really big strategic changes and, dealing with this constant storm of regulations and environmental stuff. Today we're doing a deep dive into FirstEnergy Corp and its subsidiary, Jersey Central Power and Light JCP&L. We've got their latest SEC 10Q filing, the one for the quarter ending June 30, 2025. Our mission: to unpack it for you. We want to help you get the core financial stuff, understand the big strategic moves they're making, and also shine a light on those complex regulatory and environmental challenges shaping where they're headed. Think of this as your shortcut. We'll cut through the jargon, highlight the key facts, the figures that really matter for this critical piece of the energy puzzle. Okay, let's unpack this. The numbers from this quarter, they really are pretty eye-popping for FirstEnergy. How do they pull off such a substantial jump in earnings this time around?
Yeah, eye-popping is a good word for it. The real headline is earnings. Attributable earnings just shot up. We're talking almost 500%. That's $223 million more than last year, bringing it to $268 million for the quarter, 0.46 per share.
Wow.
And if you look at the first 6 months, it's also quite strong. Earnings more than doubled compared to last year, up to $628 million. Revenues climbed too, not quite as dramatically, but still up. 3% this quarter, nearly 9% for the first half of the year.
Wow, a 500% earnings increase.
Yeah.
That's quite a turnaround. What were the key drivers? What made such a difference?
Well, it's interesting because it wasn't just one single thing. It was, multiple factors all kind of coming together. First off, higher customer usage. People use more power, especially early in 2025. We had some colder weather then.
Right, weather always plays a part.
Definitely. Then they got increased revenues from implementing these things called base rate cases over in Pennsylvania.
Yeah.
It's basically the formal process where they get regulatory approval to adjust customer rates. So more money coming in there.
Okay.
And beyond the revenue side, they managed a pretty significant drop in other operating expenses. Part of that was simply not having some big one-time hits they took last year.
Oh, okay. Like what?
Things like costs related to final rules for cleaning up old coal ash sites, those CCR rules. And there was a $32.5 million contribution commitment from their Ohio companies last year that didn't repeat. And maybe most importantly, they didn't have those huge civil penalties and settlements from Q2 2024 weighing them down.
Right. I remember that. There was that big SEC penalty.
Exactly. A $100 million SEC penalty.
Yeah.
And another, was it $19.5 million settlement with the Ohio Attorney General. Those weren't on the books this quarter. And finally, lower interest expense helped too. They've been actively managing their debt, paying down some long-term stuff, borrowing less short-term.
So it really sounds like a powerful mix. You've got higher demand, rate adjustments kicking in, some good cost control, and maybe the biggest piece, just clearing the decks of those major legal costs for the previous year. Are there, any hidden risks here? Any market headwinds that might slow this down? Or does it feel like FirstEnergy is sort of in the clear for now?
Well, in the clear is probably too strong. As we'll get into, the external environment, especially regulation, is always dynamic, always shifting. But yeah, for this quarter, their financial house definitely looks healthier, much healthier. And you can see the confidence from the board, too. They increased the quarterly common stock dividend back in March.
Oh, yeah. By how much?
Added 2 cents per share, bringing it to 0.445. If you look annually, that's more than an 11% bump in the declared dividend since 2023. So they feel good enough to share more with shareholders.
Okay, an 11% dividend increase since 2023. That sends a signal. Now, here's where I think it gets really interesting. Beyond just the numbers, this filing shows FirstEnergy making some pretty significant strategic moves, reshaping the business. What stands out to you there? What are the key shifts?
Well, the internal shakeup is definitely a big one. Back in March, FirstEnergy announced these organizational changes. They said it was designed to align with a new business model, the focus. Efficiency, sustainability, and more accountability.
Okay, so restructuring internally, what did that actually involve?
It led to a workforce reduction, though relatively small, less than 3%. About 200 employees were reassigned to different roles. It wasn't free, though. They took a pre-tax charge of about $26 million in Q1 because of these changes. About $5 million of that hit JCP&L specifically.
So streamlining the organization for efficiency, does that efficiency focus extend to managing their, long-term financial promises like pensions?
Absolutely. You can see that in their pension de-risking strategy. That's also quite notable. In January 2025, they did what's called a lift-out transaction with MetLife.
A lift-out? What exactly does that mean?
Essentially, yeah, they transferred a big slice of their pension plan, both the assets set aside, about $640 million, and the actual obligations to pay future benefits, around $752 million to MetLife. This was for about 2,000 former employees, mostly from their old competitive generation business.
So it's like handing off that whole chunk of pension responsibility.
Pretty much. It moves the risk associated with managing those assets and liabilities off FirstEnergy's books and onto the insurance company, MetLife. It helps reduce that potential volatility, swings in the market affecting their pension funding status. And a key outcome is they don't expect they'll need to make a required cash contribution to the pension plan until 2027.
De-risking pensions. That sounds like a pretty smart financial move, especially with market uncertainty. But just thinking for our listeners, are there trade-offs here? Any complexities with a lift-out like this? Is it always a clear win?
Well, the main goal is de-risking. Reducing that exposure to market fluctuations that can really mess with pension funding levels. The trade-off is often the upfront cost or premium paid to the insurance company to take on that risk. But clearly, FirstEnergy crunched the numbers and decided that the long-term stability and predictability were worth it. And it wasn't just pensions. They've been really active managing their debt structure too, very active. In June, FirstEnergy issued, $2.5 billion worth of new convertible notes.
Convertible notes, how do those work?
They're a type of debt, but they have an option under certain conditions for the holder to convert them into FirstEnergy common stock later on. It gives the company some flexibility, and it can be attractive to certain kinds of investors. They issued 2 sets, one due 2029, one 2031, with pretty low interest rates, actually. They raised about $2.47 billion net from that.
Okay, and what did they do with that cash?
A big chunk of it, about $1.2 billion, went straight to repurchasing some older convertible notes they had out there, ones due in 2026, so refinancing essentially. And their subsidiary, JCP&L, was also in the debt market. They issued $700 million in regular senior notes back in December 24, due way out in 2035. So yeah, lots of moves. Shows they're really strategically managing their balance sheet, their debt profile.
That is a lot of financial maneuvering. And it seems like they're also streamlining the types of businesses they're in, aligning with that strategy to be a fully regulated company. Tell me about the divestment.
Yes, exactly. That fits right in. On July 16th, just after the quarter ended, actually, FirstEnergy Ventures Corp, that's FEV, sold off its entire stake in a company called Global Holding. That holding company runs the Signal Peak coal mine and related transport operations out west. FEV owned a third of it. They sold it for $47.5 million. It completely aligns with that stated goal. Get out of the more volatile, non-regulated businesses like mining and focus purely on being a regulated utility.
Okay, so streamlining operations, de-risking pensions, actively managing debt, and divesting non-core assets. That's a lot of strategic action. So what does all this groundwork mean for the future? Especially thinking about the actual grid, the infrastructure, how they operate day to day. Sounds like big investments are happening there too.
They certainly are. And it was a huge, huge undertaking. You're seeing major transmission investments planned through this new entity called Valley Link. FirstEnergy Transmission, FET, formed it with a couple of partners late last year, Dominion High Voltage and Transource Energy. Then, earlier this year, PJM, that's the grid operator for a big chunk of the East, selected projects proposed by Valley Link. We're talking roughly $3 billion in investment.
$3 billion. Wow, what kind of project?
Building new transmission lines, upgrading existing infrastructure. It's all about strengthening the grid backbone. And crucially, FERC, the federal regulator, already gave it initial thumbs up. They accepted requested rate incentives for these projects back in May.
Rate incentives, meaning they get to earn a bit more profit for making these big investments.
Essentially, yes. It's designed to encourage utilities to undertake these large, necessary, but expensive grid upgrades. So that's a positive signal for the Valley Link projects.
That's definitely a critical piece, a huge investment in the backbone infrastructure. What about specifically within JCP&L's territory in New Jersey?
JCP&L got a big green light, too. Their Energize NJ program got approved by the New Jersey Board of Public Utilities, the NJBPU, back in April. This program just kicked off July 1st, runs through the end of 2028. The total cost is around $339 million, and a big chunk of that, about $203 million, is direct capital investment in things like grid modernization, making the system more resilient, think fewer outages during storms, and upgrading substations. Stuff customers should see the benefit of.
Okay, big investments in New Jersey, too. Now, let's talk Ohio. It always seems like Ohio is a particularly dynamic and challenging regulatory place for FirstEnergy. What's happening there?
Ohio is definitely complex. It keeps everyone on their toes. Their Ohio operating companies are still navigating some tricky regulatory stuff. Remember their ESPV proposal? That got withdrawn. They're back to operating under a modified version of the previous plan, ESPIV. And there's actually an appeal about that whole return to ESPIV pending right now with the Ohio Supreme Court. Briefs are due very soon.
Okay, so uncertainty there. What about their rates?
They're also in the middle of a base rate case in Ohio. They initially asked for a net increase of about $94 million. Then they revised that up to $190 million. But, and this is a big but, a third-party auditor looked at it and recommended an increase of only about $8 million.
Wow, $190 million requested, $8 million recommended. That's a huge gap.
A massive gap. They held evidentiary hearings back in May, so the outcome there is still very much up in the air. The Public Utilities Commission of Ohio, the PUCO, has a big decision to make. And all of this is happening against the backdrop of major legislative change in Ohio. This really raises a crucial question. How is the new House Bill 15 going to fundamentally change things? It was signed into law in May, takes effect mid-August, and it could potentially set precedents for other states too.
HB 15, what does that do?
It's a pretty big overhaul. It gets rid of those electric security plans, the ESPs, that have caused so much debate. It mandates base rate cases every 3 years, triennial reviews. So more frequent, regular scrutiny of utility costs and rates. It also aims to speed up the PCO's review process for certain things. It really signals a shift towards trying to increase transparency and accountability for utilities in Ohio. It's a potential game changer there.
That does sound like a significant shift, more regular scrutiny forced upon them.
Okay, switching gears slightly, what about West Virginia? Are we seeing a similar push towards renewables there? Yes, there's definitely movement in West Virginia. Monongahela Power and Potomac Edison, their companies there, are continuing to build out their approved solar projects. The third of 5 planned solar sites actually came online back in April. They're working towards the total 30 megawatts of solar generation that got approved. And Monongahela Power, or MP, is due to file its next big 10-year plan, the Integrated Resource Plan with the West Virginia PSC, by October 1st. That plan will outline their future power generation needs, and you'd certainly expect to see a continued, probably growing, emphasis on renewables in that plan.
All right, let's tackle the really big picture stuff now. The push for cleaner energy, the green transition, but also the legal hurdles that seem to constantly pop up. What are FirstEnergy's environmental commitments, and what kind of challenges are they really facing here? It sounds like a true tightrope walk.
It absolutely is a tightrope walk. On one hand, FirstEnergy has made a clear pledge, carbon neutrality by 2050. That's for the greenhouse gas emissions they directly control, Scope 1 emissions. This means phasing out coal. They've set retirement dates for the remaining coal plants. Fort Martin by 2035, Harrison by 2040. So the direction is set. But the regulatory landscape they need to navigate to get there is anything but stable. It keeps shifting. Just back in March, the EPA announced it's going to reevaluate or reconsider a whole bunch of environmental rules, things impacting greenhouse gas emissions from power plants, rules about water discharge limits to the 2024 ELG rule, and those coal ash disposal or CCR rules we had mentioned earlier. These reevaluations create significant uncertainty. They could lead to new requirements, potential litigation. FirstEnergy constantly has to assess, okay, what do we need to do now to comply, and what might we need to do next year?
So even as they're making these long-term plans for a greener future, the actual goalposts, the rules of the game could move on them. What about dealing with the legacy, the environmental cleanup from past operations? Sounds like there's still a lot on their plate there.
Oh, absolutely. That's a major ongoing effort and expense. For instance, remember the coal ash discussion. In March, one of their subsidiaries, AE Supply, transferred a big coal ash facility, McElroy's Run, and an adjacent landfill, plus all the cleanup obligations, to another company. To cover the costs, they set up a $160 million escrow account, funded over 5 years, and backed by a FirstEnergy guarantee. So they're still financially responsible, but managing it differently.
Okay, managing the coal ash legacy. What else?
Beyond that, they've accrued, meaning set aside money for about $93 million for cleaning up other historical waste sites. Under the Circle A, that's the federal Superfund law. A big chunk of that, $67 million, is for cleaning up old manufactured gas plant sites, MGPs, and gas holder facilities in New Jersey. And JCP&L is actually recovering those specific New Jersey costs through what's called a societal benefits charge.
Societal benefits charge, so that's a fee on customer bills.
Essentially, yeah. It's a small, non-bypassable charge that basically spreads the cost of these necessary historical environmental cleanups across all customers as a common mechanism utilities use for these kinds of legacy costs.
It really does sound like they're constantly navigating a legal minefield, balancing current operations, future plans, and past liabilities. What's the latest on those Ohio House Bill 6 audits? That whole situation was so controversial, it really seemed to damage public trust.
Yeah, the HE6 fallout continues. There are still ongoing investigations looking into political and charitable spending connected to that legislation. The audits related to the utility funds, specifically something called the Distribution Modernization Rider, or DMR funds.
Yeah, go.
Well, the auditors reported they found no documented evidence definitively tying those specific funds to lobbying for HB6. But, and this is important, they also said they couldn't completely rule it out, so still some ambiguity there.
It's not exactly a clean bill of health then.
Not entirely. A later audit looked at about $75 million in payments under scrutiny and concluded less than $5 million was even allocated to the FirstEnergy Ohio companies. And the resulting impact on rates for a specific customer group pole attachment customers was found to be tiny, less than $15,000 total. They held evidentiary hearings on these audit findings back in June.
So the actual financial impact on customers from that specific pot of money might have been small, but the perception issue remains huge.
Exactly. And that really highlights the intense scrutiny utilities are under regarding how they spend money. And it shows how public perception, the narrative around potential wrongdoing, can really diverge from the specific findings of an audit about, say, the direct financial impact on customer bills. The reputational damage can be far greater than the dollar figures involved in one specific audit point.
That's a really crucial distinction. Okay, what other legal battles are brewing that could significantly shape their operations, maybe hit their bottom line?
Well, there's a pretty significant one involving transmission return on equity, or ROE. It's about an incentive adder. The Sixth Circuit Court ruled back in January that a 50 basis point adder utilities were getting in their transmission rates just for being members of an RTO.
Sure.
A regional transmission organization like PJM is only allowed if that membership is voluntary.
Okay, and for FirstEnergy?
Well, for ATSI, one of their big transmission subsidiaries in Ohio, state law mandates RTO membership. It's not voluntary. So because of that ruling, ATSI had to recognize a $46 million pre-tax charge plus interest, basically setting aside money for expected refunds to customers.
Ouch. $46 million plus interest, is that the final word?
Not necessarily. FirstEnergy has appealed this to the U.S. Supreme Court. They've applied for review, so that fight isn't over yet. But losing that 50 basis point adder permanently would directly impact how much profit they're allowed to make on billions of dollars in transmission investments. It's a big deal financially.
That's definitely a big one. Hitting profitability. Any other major litigation that could impact their big plans for future investment?
Yes. There are also ongoing complaints filed at FERC, the federal regulator, concerning how FirstEnergy plans and approves certain transmission projects, specifically things called supplemental projects and local transmission facilities. The groups filing these complaints allege that FirstEnergy is sometimes overbuilding transmission, leading to unjustified rate increases for customers. They're calling for things like more independent monitoring and stricter approval processes before these projects get built and added to customer bills. This litigation is ongoing, and depending on how FER rules, it could materially impact FirstEnergy's whole transmission capital investment strategy, those billions of dollars in grid upgrades we talked about earlier.
Okay, so we've really covered a lot of ground here. We've taken this deep dive into FirstEnergy and JCP&L. We've seen how they're managing, significant financial growth this quarter, while at the same time executing these major strategic shifts in their structure, their debt, their assets, plus undertaking these massive grid modernization investments. And all of this while navigating this incredibly complex, often contentious regulatory and environmental landscape. It really is a balancing act on an enormous scale, isn't it? And one that affects millions of people. So, thinking about everything we've discussed, what stands out to you? How does a major utility like this manage in such a multifaceted world where its financial health is just so deeply tied to regulatory decisions, environmental pressures, even political wins? And here's maybe a final thought to leave you with. Given FirstEnergy's clear commitment now to becoming a fully regulated utility and those ambitious carbon neutrality goals, how can they successfully balance it all? Balance the immense long-term capital needed for modernizing the grid and decarbonizing while also delivering returns to shareholders? Especially when the policy world keeps shifting and economic pressures aren't going away. It's a massive challenge. One that will really define not just FirstEnergy's future, but maybe the path forward for the entire utility sector. Lots to think about there.